segment of our monthly web series. Steve and I are excited to chat about today's topic. Going to give it another minute or two here as we get going. Today we are going to be utilizing the Q&A. So feel free to utilize the Q&A as we go throughout today's presentation. Submit your questions. Basically, just giving you an area to interact with Steve and I as we go through today's presentation. The idea behind today, guys, is to provide information. It's the same goal we have every month when we jump on here for this webinar, is to really just share some information, share some insights into what we're seeing, how we're seeing people leverage the different financing instruments that are available to small businesses today. What's interesting is small business is such a broad term. You have small businesses that are super duper tiny, right? They could be just a couple of employees, but because of technology, because of the reach that they have here in 2024, they're doing big numbers, right? You can have some of these small tech companies that sell a piece of software or a product that they could be in the tens to 50, $100 million range. Yep. And they got 5 employees, 8 employees, 10 employees. Versus the local landscaper, right? Who has a similar type of staff, right? They're maybe 3, 5, 7 employees, a couple crews, maybe 2 trucks, 3 trucks, yep. A couple pieces of equipment. Maybe they're doing some masonry, or they're involved in maybe a little bit more than just the landscaping, but they're in the couple $100,000 to maybe $1 million, annually type of business, right?
That's right.
And then you have the startups, right? Everybody wants to talk startups. Everybody wants to talk about getting going in business, and I'm one of those people. I love a good conversation around startup because people borrow money for 2 reasons, right? They say opportunities and challenges. I look at it like, regardless of whether you're facing a challenge or an opportunity, the capital side of it is certainly an opportunity. And if you view it that way, you can take advantage of the capital that's available today. So again, Steve and I are super duper excited to chat with you guys here. I see a question already about this being recorded. Of course, this is going to be recorded. We're also live on social media, so shout out to you if you're on LinkedIn, Instagram, Facebook, YouTube. Thank you, Lauren. Any of the social platforms. If you want to jump over to Zoom, feel free, where you can interact with us in the Q&A. We're going to get the presentation going. Today's topic is gaining access to $1 million for your small business, right? I think there's this stigma around the 2 commas. When you get that second comma, right? People start to realize that's real money. I'm not saying that, your first 5,000 or your first 10,000 isn't real money. That's not what I'm saying. But what I am saying is when you're borrowing money and you're borrowing 5 or 10,000, the bank looks at that totally different than they look at you borrowing $1 million. So
for sure,
it's the same thing outside of banks. It's the same thing in the fintech world. It's the same thing in the, equipment finance world. And we're going to go into a lot of it here. What does it take to qualify? What are your, the common pitfalls? Where are people, falling short currently? But why this conversation? And Steve, feel free to weigh in here some. Today's conversation is really because we're seeing now more than ever, the need for borrowing $250,000 to $10 million outside of the bank is greater than ever.
Yeah.
I don't know what it is. I think banks are just a little bit uncertain. And with that little bit of uncertainty, if it's not perfect, they're not lending. They would rather lend you 15 million or 50 million if you can afford it, right? And if you can't, they're looking at that 10 million and under bucket as, like sub debt, right? Like almost like outside of what they want to be doing. So because of that, there's a lot of opportunity for people like our partners that are on this conversation, and ultimately leveraging resources like the ones we have. So, well, go ahead.
Yeah, no, just what I was about to say is if anyone does any research at all on this, you'll find what Tony's saying is right in line with what's happening currently in the current markets. Private credit has been on a substantial growth pattern for the last 4 or 5 years, and is really, really challenging conventional banking and private equity. What I mean by private credit, I mean, not institutional lenders, not bank level. These are private groups that pull together funds from a group of investors. They put together a fund, and they determine an investment mandate, meaning a set of guidelines, a set of capital guidelines that they're capable of lending on. And all those details are typically predetermined. So when you go apply with any type of private credit institution, or of course a conventional bank, they know their guidelines already, right? So when you go in and you apply with them, they're looking to see if your ratios match their guidelines, if the specifics of your financing request, your credit package meets their guidelines. If it doesn't, then unfortunately that's not a deal that they can lend on. But private credit has expanded that criteria, their lending criteria and capability over the last several years dramatically. And again, that's why they're posing a significant challenge to conventional banking right now.
And a big part of that is just the need itself, right? When you have borrowers that have real needs, and they have assets, and they have revenue, and they can afford these things, it's not necessarily about anything other than access to the capital. So when you start to have these private lenders and online lenders that are coming in and filling in these unique niches, whether you're talking equipment finance, you're talking CRE, you're talking MCA, whatever lane you want to talk, the lenders in these industries, they're there to lend money. And I think that's what makes them so different than a traditional bank. Is the traditional bank is there to hold your money.
That's right.
So
they're there to trade it.
Yeah.
More so than anything. Yeah. People forget that. In banking, right? That's where they make their money. 100%. They make their money on the trade side.
Yes, 100%.
So earnings from interest on loans or leases, that's just extra. Very small.
It's a small portion of how they're actually making their money. It's, a lot of it has to do with real estate investment. A lot of it has to do with naming rights. You always see like the Wells Fargo Center or Bank of America Arena, or, that's where your deposits are going, in case you were wondering.
Yeah. No,
and then into the insurance world, right? Yeah. Banks are huge in the insurance world. So, once banks were allowed to own assets like an individual, it opened up the world for them to invest, right? And that's what they've done. And you can't blame them for it, but you need to know what's the playing field look like, so that when I go out there, I'm putting my best foot forward. And that's what today's all about. So we'll get into the presentation here. 92 people. See, we were joking before because there was only a couple of you on. So shout out to the first few, because we were a little nervous there for a second. But now 93 people. We're getting going. I'm Tony Cimino, VP of Business Development here at Rock. We've been going at it for 4+ years now under the Rock brand, but we've been funding commercial finance for 15+ years. Steve, to my left, who's our director of commercial finance, has been with us almost a year already, which is crazy to think how fast that year went. Yeah. But at the same time has been in the industry, 20+ years now?
About 22 years now. Yeah.
And Steve's whole focus, guys, what makes the tandem, or the twosome, the gruesome twosome here, what makes us so powerful is our complementary product knowledge. Right? Steve comes from a world of where he's been in traditional lending. He's seen what it's like on the back end of working with banks and through banks. And then even outside of that, but more focused in the commercial real estate, asset-backed types of products, as well as equipment financing. And my own experience has been in primarily unsecured financing. So everything outside of what I just mentioned, you're talking term loans, lines of credit, getting cash to business owners directly, right? No assets tied to those products. So we're going to dive in here. A little bit about Rock Financial, right? We've been, like I said, rocking and rolling and funding businesses for a good amount of time now, and we pride ourselves on the process. Not to quote the Philadelphia 76ers, but we are totally about trusting the process here. We are tied to the process, not the outcome. If you are a borrower looking for information, we are a great resource for you. You can utilize our website, you can utilize our social media, but most importantly, you can leverage our team, our team's knowledge, our team that is consistently seeing 10,000+ applications per month for funding, and then all the information that comes from having that tool, right? So we know who's doing what, how much money they're approving, what the terms are, and then we give that information back to you guys in forms of great webinars like this one. So today's conversation, question number one, what do I need? Like, what qualifications are there for $1 million business loan, right? Question number two, how long does it take me to get $1 million, right? And then question number three, what are the products? Right? How do I leverage what's out there, what I have, and ultimately blend between the qualifications of the products and the products themselves? How do I leverage that into getting $1 million+ dollars? Well, there's going to be a few things, and we're going to go over kind of all of these things. Credit worthiness, and these are not in order, because if they were in order, I would put use of funds first. Just throwing that out there. Yeah. Steve might disagree, but I think he agrees.
No, that's a pretty, yeah. What's the purpose, right?
Exactly.
Let's start there. What's the goal? What's the purpose?
Well, because that'll give us the product, right? That's the key here, guys. You don't decide what type of funding is best for you. Your need does, right? So if you're buying equipment, there's equipment financing, there's cash, right? But you're probably not going to go get a commercial real estate loan to buy equipment. Like, that's not smart, right? So just understand that, right? Like, and I know that may sound like basic information, but that's exactly what the underwriters are going to do when they look at your applications from the businesses you work with. They're going to see, are you checking boxes or are you not? Right. Well, if you're looking for equipment, we can't give you a commercial real estate loan, right? Do you meet the credit? I mean, do you have the assets for something like an AR line, right? If you don't have receivables in your business, if you're a restaurant, unfortunately, there's no receivables, you have to be in the B2B industry, right? So now we're starting to eliminate options, eliminate products, ultimately dialing down to now, okay, the products that are available, are you the right candidate to apply for them? And will you ultimately get that approval that you're looking for? But more importantly than an approval is actually getting the funding. And I think that that's another big part of this. I see a lot of lenders these days that will approve deals. I see a lot less that are funding them.
Right.
When push comes to shove, it's very easy in the marketplace, right? Imagine being a lender. Let me paint a picture for you for a second. You have a borrower that needs $500,000, right? And you believe that you're really only going to give them 100,000, right? But you want them to go with your offer. Why not show them a $500,000 pre-approval up front, and then based on whatever stipulations you already knew you were only comfortable with 100,000 anyway, you're going to rework that thing on the back end. It happens all the time, guys. I'm not telling you information that's not readily available for you if you apply for funding these days. So that's where we're seeing through the lens of all of the information that we have and saying, okay, I see you like to approve deals up to 500,000, but you only like to fund them up to 150,000. Right. And we have the numbers that will tell us that. So if we have a borrower that needs 150, you're the one. But if we have a borrower that needs 500, we're going to have to go with your competition. Even if they move a little slower or they require an additional document or two, they're getting those deals done where you're not. And that's why this is such a detailed process, right? $1 million is you might only have one shot at applying. When you apply with the right lender the first time with all the right information, it becomes very easy to get $1 million.
That's right.
It's when some of these things are out of whack that it becomes challenging, right? So number one, use of funds. Number two, I would blend the rest of them.
Yeah, they pretty much they tie together
Yeah.
pretty well. Yeah.
Yeah. As far as like the banks themselves, the lenders themselves, the people that are going to give you the money, affordability is the next thing for them. They're going to look at, all right, at a very base level, when we give them the payment that they're going to have for how much money they're looking for, how does that affect the business, right? If it affects the business negatively, well, they're not going to do it. And believe it or not, if it's too positive, right? If there's too substantial of a change to the business, they don't like that either. They like to see that when you take $1 million, it's because you needed $1 million to keep the operation status quo. You might see a 5% bump or a 10% bump in your business, but they don't want to see that you're adding, a whole new product line that you've never done before. And, you might think that that's a great opportunity for yourself as a business owner, and it is. But the underwriter wants to know that regardless of this new opportunity, you're going to be able to pay back this loan.
That's for sure. Yeah. So any lender is going to look at the potential risk associated with the capital that they're potentially investing and lending into the borrower, into the business. Starting something that's brand new is considered to be high risk. The use of this is kind of like back to the use of proceeds, right? It's got to make sense, right? 100%. Like if they see that this is basically almost like a side business that you're developing into your existing business. Well, they want to know, you have experience with that. Yep. You have a solid plan for this. You have everything makes sense, basically. That you know what you're doing. You're going into the project with a good understanding of what you're doing. And even with sufficient experience and a solid business plan, again, if it's a brand new endeavor, it doesn't really mold well into your existing model. Well, it's absolutely high risk, and
it becomes extremely difficult. Yeah, it becomes extremely difficult to get access to that type of capital. So, I'm not going to tell you be careful what you tell the underwriters, right? Like that's the wrong piece of advice. What I'm telling you is make sure that when you're applying for funding, you have a clear, precise plan that is going to utilize that capital in a way that is not going to create major waves. Yeah. That's what I'm telling you. It should be status quo, right? If you're borrowing $1 million, it shouldn't be because your business only does $60,000 a year. And if you only had $1 million, you could do 10 million. Well, this is an investment. This is the lending industry is not built on the chance takers. That's they're professional gamblers. Essentially the underwriters are professional gamblers, and they're taking a look at the risk and the reward, and they usually overprotect themselves.
That is 100% certain.
And it's smart to know that as a borrower, right? Because you can leverage their capital. That's the upside to it, right? I was able to buy my house because I was able to leverage capital that was not mine, regardless of what the interest rates were or where they were going or what everybody was saying at the time. I still bought a house in the last 24 months. It's when you need it, you need it. Credit worthiness. This is one that I wanted to point out really quick before we go to the next slide, just because you have a multitude of different kinds of credit worthiness. Excuse me. I can't even say that. And where I want to start with this is to just kind of expand your thought process a little bit, because everybody goes right to their FICO credit score, as you should. If you're a sub 500 borrower, getting $1 million is probably out of the question. If you're a 650 borrower, now we're starting to get there. If you're a 700 plus borrower, you have a much better chance. We're starting to get to where we need to be as far as like personal FICO goes, right? But it's bigger than that. If you're talking about a property purchase, whether it's commercial real estate, it's residential investment, whatever, if it's $1 million purchase or refi or whatever it is, part of that credit worthiness is the actual property itself. Is the appraisal that they're going to do? Is how recent was that appraisal? All of that is part of the credit worthiness. If you're talking equipment financing, it's the equipment itself. The equipment itself becomes part of it. And where is that equipment tiered, right? Like you may be saying to yourself, like, what is Tony talking about? Well, if you're a dentist, right, and you're going to outfit your whole office, the tiers of equipment are going to be much different. For example, the seat that they sit in your office is going to be one. The x-ray machine that you use is going to be in a different tier. The little thing that you use to, suck all the saliva out is going to be a different tier of types of equipment. And based on where that invoice adds up and the different types of equipment, that's going to give you the overall credit worthiness of that application, right? That all becomes a part of this when you start to tie assets in, when you start to tie the business in. There's business credit, there's personal credit of the owners. There's a lot that goes into credit worthiness.
Additionally, I mean, one of the things that gets overlooked very often is even if you have a strong credit score, you could have a 750 plus credit score, but if you don't have depth of trades or you haven't had any established trade lines that are similar to the type of trade line that you're requesting in terms of amount or monthly payment. And usually the lender is going to use a ratio. It doesn't have to be dollar for dollar, but they might say, hey, it's got to be you have to have at least one trade. This is very common with equipment financing. You have to have at least one trade for, let's say, and again, every lender is different, but one trade that's at least half of the original balance is at least half of the invoice amount or the total financing request. So if you're going in and you're asking for $1 million, and it's one of these, non-bank equipment lenders that has these types of guidelines where they're looking at, prior trade line activity. Again, that would mean if their guidelines specify that they want to see at least one active trade open for at least a 12 to 24 month period for at least half, the original balance being at least half of the financing request, you're asking for $1 million. That means you have to have at least one trade line for $500,000 open for at least 12 to 24 months with no late payments. That's the other key. No late payments. If that trade has any late payments on it during that time frame, then that trade line cannot be counted or considered towards the underwriting process. So that gets overlooked very, very often, as you noted. Yeah, PayNet just as important. So you could have a borrower. We just had this happen. We had a borrower looking for SBA financing. Phenomenal personal credit, like a 780 plus score, plenty of depth of trades. Excellent cash flow in the business. The PayNet score came back abysmal. I don't remember exactly what it was. I believe it was below 640, or depending on which one they ran, it was not great. It was subpar, and that alone blew up the deal. That PayNet score blew out the deal on its own. So so lenders on a commercial level, on a business level, lenders are looking at personal credit, depth of trades, and PayNet business credit. All are significant to the underwriting process.
200%. So we just touched on this a lot, but just to kind of summarize it for you again, right? The ability to repay the loan, right? Regardless of the scenarios, if things worked out with the deal, if they didn't work out, right? If whatever, you have to be able to repay. They're looking to lower the risk by any means. So if you have assets, they're going to look to overprotect themselves on their investment, right? So they're going to look to tie those assets to this type of deal. And one of the things that I want to make very clear is, where does this level start, right? It's different for every lender. But like when you're talking about $1 million, anybody that's lending $1 million, this is what the system looks like, right? For some lenders, it's over $150K that they become full package, right? Or full pack. If there is another lender, it might be 250,000. Some lenders now, where we're getting less and less, it might be 300 or 350,000. Then there's very few that number is 500 or 600,000. When you start to talk about the people that are giving you $1 million, it's a small bucket.
Yep.
The industry, they work together. The industry is small. Pack. Yeah, and it's always a full pack. Exactly. So just keep that in mind as you're applying or as you're thinking about working with borrowers who need this much money, right? So we touched on this a little bit, right? Secured lending, unsecured lending, some of what Steve's prior experience was versus where my own has been. And I wanted to just make sure that we had a slide that really went over that for you guys to show, hey, they're different arms, right? With two hands, but both hands wash the face, right?
Good analogy.
Yeah, yeah. So just keep that in mind, when you're using this. What we see a lot of times is borrowers who will combine some of the different scenarios, right? Where they may say, hey, I need a certain amount of capital for equipment. I'm buying this $500,000 piece of real estate, and I have a need for $125,000 in cash, right? So they'll use a couple of different products, right? There may be a commercial real estate piece. There might be a line of credit piece or a term loan piece. There might be equipment financing. All of this might get wrapped up with an SBA inside of 6 to 9 months, depending on what the long-term process looks like, right? So I just want to keep that in mind as we go through the next few slides. Not only are these products interchangeable in terms of a $1 million request a lot of the times, but you'll also see them be used in tandem to get somebody to where they need to be. Just keeping the presentation going here, right? I told you we were going to go over some of the common mistakes, right? Number one, I would say, is this not enough collateral.
Absolutely.
Right? And what does that mean? Well, one of the biggest things that people forget is when you look at from an accounting lens, you look at cash in a business. Cash is an asset. Assets are where collateral comes from. So if you don't have enough cash, right? I know not profitable is also on here, but like if you don't have enough cash on hand, well, they're going to see that. They're going to see that you can't really afford the loan. And then obviously there's all the other assets, right? We talked a lot about overprotection. So if you're looking at somebody and they do have AR and their AR is paying, well, somebody's going to look to scoop up that accounts receivable, right? They're going to want to put a lien on that just to protect themselves. Right now, if they're a borrower who's looking for $1 million and all they have is 250,000 worth of receivables, well, that's not probably enough, depending on how quickly they're turning that and how quickly, things are looking. But for the most part, 250 isn't going to get you $1 million. So you have to remember that, right? If you're talking about a property, you can't get $1 million on a property if it's worth 600 grand and you owe 500,000. Sure. And I know that, for a lot of people on this call, that may seem like, simple information, but there's a lot of misinformation out there. So I just want to be very clear about, like, when I say not enough collateral, I'm talking about you have to actually be over and above if we're talking the collateral world. Now, same thing in the cash world. You want to go get $1 million cash advance or term loan or, line of credit from somewhere, you're going to need a substantial amount of cash to qualify for $1 million. That's really what it comes down to. Poor credit, automatic no. I would say as far as, the SBA is concerned, you can get as low as like a 640,
650, 640 in some cases.
Yeah, we're pushing.
Yeah. I mean, and in those cases, you need compensating factor. Something else has to balance out the lower credit score, like really strong cash flow, strong collateral, something there that really, boosts and carries
a great use of funds.
Right. Averages out the low weight. Yeah.
Yep.
Use of proceeds. If they're taking, the consolidating debt and their debt service coverage ratio is going from a 1.05 to a 2, that's a major compensating factor. Yep. Things like that will help.
Buying real estate in there, that'll help. Again, that's probably the bare bones minimum across the board here. If you're going to qualify for an AR line of $1 million and they pull your credit and they see that you're, 620, it's going to be tough. It's going to be tough. I would say you're looking 650 minimum. You're looking, at you have to be making a good amount of money.
50 magic number when we're talking about conventional or any type of secured type of loan where there's a cash flow parameter, a cash flow driver in the underwriting guidelines, the magic number is 15% more EBITDA than proposed debt. So what do I mean by that, right? If EBITDA is 115,000 annual and total debt, meaning the debt that we're proposing plus any other existing debt, if they have an equipment loan, if they have so any other type of working capital loan that we're not going to pay off through our loan proceeds, then the total combined annual payments for that debt would not be able to exceed 100,000, right? So if we have 115,000 in EBITDA and we have 100,000 in total proposed annual payments on the debt, total debt obligation, 115 is 15% greater than 100. So that's the magic number. 1.1, that's the same thing as saying a 1.15 DSCR. So anything more than that means that you're in pretty good shape in terms of cash flow.
And that's going to be, I know the last few, right? Not enough time in business, no business checking account, right? These seem like, simple factors, but again, it's common mistakes. You wouldn't believe how many people are making a lot of money, but they're using a personal checking account. Like we see it all the time.
One note, I just want to come back to that slide, if you don't mind, Tony. Tony, I don't even know if you realized it, but what we just outlined here are the 5 C's or the 5 pillars of credit and underwriting. So not enough collateral. Collateral, that's one of the main points of underwriting. What's the collateral? What's the asset that we're leveraging? Poor credit or character. That's one of the other C's, right? And obviously we're talking about their credit rating, personal credit, as we talked about, pay net as well, depth of trades as well, as we noted before. Profitability, that talks about cash flow, the ability to service the debt payments, the debt obligation. Not enough time in business. This is what we refer to as conditions. So use of proceeds, the potential rate, is the rate 20%? I mean, where that's exorbitant, would that make sense for the lender? Is that posing too much of a high risk for the borrower to afford? The loan amount, is it just simply too high for the type of business that we're working with? The industry, maybe the industry is specifically struggling a bit. Transportation right now has been struggling in the last several years. So that's all part of the conditions part of the deal. Bank account. We're talking about capital, cash on hand, reserves. So if they have if they have 12 to 24 months of reserves on hand at all times, well, that lowers the risk quite a bit. They can go through a couple of months of a downturn and still survive.
Yep, exactly, 100%. So just to kind of clear it up, right? If you're going to go get $1 million, and this is minimums. I want you to know, like, this is minimums. I'm not guaranteeing you're going to go get $1 million if you meet this. But I'm guaranteeing that you can apply for it, and, with the right guidance and with the right, the right mixture of products and, the right use of funds, you can get there. But this is the bare bones minimum. We were talking about it just a couple seconds ago, 620, 640, 650. That's pretty much, the bare bones minimum on the credit side. We're seeing anybody that's going to get $1 million, they got to be doing $3, $5, $10 million annually. They're real businesses that have real problems or real opportunities. And that's what they're using the $1 million for. It's, it's a big part of it. Now, why we're talking about it again is because most people aren't servicing this part of the market at the moment, right? So what does it look like to service the market? Well, this is what it looks like, right? You have these scenarios where businesses that have been around for a few years, they have, true use of funds, right? The first success story here, declined at their local bank. This is the one that we're hearing the most of right now. Maybe it's because most of our partners are ex-bankers or, business bankers and relationship managers, but we're seeing a lot of the declined at their local bank and are using the money as a bridge, right? Whether it's to finish a project, start a project, it's to pay off vendors, just kind of keep things going in the right direction, getting them access to more capital, right? What comes from finishing a project is cash, right? When you finish that project, the $1 million loan, all of a sudden, the loan was taken to finish the project. And, we could be talking about $3, $5, $10 million of, access to capital going forward or revenue in their business, when you're talking about the right thing here. The one in the center, professional services, we hear it time and time again, the insurance companies don't make it easy to get paid. So this borrower here, they were switching some things on the back end with some of their service providers. And because of that, they had a lapse in their ability to collect payments from Blue Cross Blue Shield.
That's right.
And it was one of their major ways of earning. Medical staffing the past few years has been one of the biggest industries. And because of that, you have a borrower here who needed the capital to continue to pay, to continue to operate their business, right? Like, when you're talking about a business like staffing, the best thing that you have are good recruiters and a team of people that are out there, doing this for you and ultimately delivering that product on the, on the back end. Well, if you're waiting to get paid on the front end and you can't afford to pay your staff, well, it's only so long that you're going to have a business, right? So, it becomes very important to access this stuff and get access to the funds.
Yeah, and in this particular case, this is a business owner that's been in a medical facility. It's been in place for many years. Very strong borrower, had an issue, not any issue that he created. He had an issue with his medical billing provider, his third-party billing provider. About 6 to 12 months, I want to say, before he went in for the application. And that issue, it actually created a butterfly effect for him, which could have been pretty severe if he had not connected with us. He had a several $1 million line of credit with his bank, a conventional bank. That bank was looking to terminate that loan. They were not looking to extend the terms on that loan because of the minor cash flow issues, temporary cash flow issues that they experienced as a result of the medical billing issues with their third-party provider. So we were able to come in and leverage their AR, which we were able to work around any of the AR that wasn't affected by the medical biller. Really, that was anything that was billed within the last 6 months out. Leveraged the AR, got him the funds he needed, gave him some additional working capital on top of it, and it was all set. I mean, it was a time crunch for sure, dealing with the timeline that the bank provided for exit of the existing loans. But again, using the right collateral, we were able to structure the right credit facility to help the borrower.
Yeah, absolutely. And then this last one here, the trucking example, this is a good way to just show how you can use multiple options or multiple products to meet what you're looking for, right? So this customer here was able to leverage their existing fleet of trucks, knowing that they're going to continue to purchase equipment, and they leverage their existing equipment to get access to a line of credit that will allow them to purchase more going forward. Now, immediately, they were buying, I think it was either 3 or 5 trucks and trailers immediately on the line. There was a need for them to add to the fleet. So what else did they take? I believe it was 250,000 on a line, or 350,000 on a line of credit, where they were able to get access to working capital on top of this, right? So that's how we get to the 1.5 million, is because they're able to utilize that line of credit and draw on it and pay it down, draw on it and pay it down, as they're hiring new employees and bringing, increased payroll. It's just there to be a reserve for them. So
this was like a hybrid equipment line,
yep,
and a working capital line, if I remember correctly, right?
Yep, correct. Where they were able to leverage their revenue separately from the equipment transaction.
That's right.
And that's the beauty of working with a broker, honestly. If you would have went directly to the equipment finance lender, they would have serviced your need. If you would have went directly to the working capital lender, they would have serviced your need. But in a broker's seat, we're able to help put the deal together, and
a perfect example of structured finance.
Yeah.
And again, with creativity on the broker level, we have access to a variety of different lenders with different options. We have the ability to get creative like that.
Absolutely. So just a couple of things, right? Why are you here? If you're new to us, and I see a couple questions already in the Q&A about some of these things. But as far as what are we talking about? We're talking about partnering with Rock, right? If you're somebody that is a partner with us already, shout out to you for being on this and coming back month after month and, being a part of our web series. But the other part is people that have never worked with us before. So just to give you a quick overview, why do partners work with Rock? Number one, it's the rock stars like Steve and I. No, I'm just kidding. It's everybody else. Realistically, it's all the other rock stars on the team. You get direct access to multiple points of contact throughout the team. And the reason that I keep saying the word team is because that's what you're joining. You're getting your own commercial finance team. I always tell every partner that signs on with us, congrats, because you just became the CEO of your own commercial finance brokerage. How would you like it to operate? And that's the beauty of our partnership. We have the technology to back that and give you the most streamlined process out there, from taking your deals from application to approval and approval to funding, and ultimately providing an extremely aggressive referral commission based on how much volume you're able to produce with us. There's residual opportunity, there's investment opportunity, there's the ability to get paid more on the upfront, there's all sorts of different things there. So if you're interested, I would tell you, make sure that you reach out to us and partner with us now, because that's really what it's all about. I wanted to do something a little different here, and this is a new thing that I think we're going to put in going forward. But I reached out to the team and said, we all work with hundreds of partners. What are some things that make a good partner, right? Because I think sometimes we talk about how great of a partner we are. Well, it's got nothing to do with us. It's got everything to do with how our partners use what we have, right? So I reached out to a few guys on the team here. You might be working with some of these guys. You may have spoken with them in the past. Shout out to these four for providing some feedback. But what's resounding to me behind this is I noticed it's more about communication than anything. Those partners that just have a real conversation are able to really take advantage of the different resources that we have. Right. So, like Nick mentioned, the best way to achieve success is by collaborating when connecting with Rock to your clients, right? Whether that's the intro call or gathering docs, you as a partner can say, hey, listen, when you work with Rock, you're going to speak with a representative who's going to walk you through your transaction, right? You may think that doesn't go a long way. I can't tell you how far that actually goes. Or it's like Justin mentioned at the bottom, it's being able to service their clientele while also leveraging the different products that we have on our platform. So we have a lot of different partners who they sell different pieces of equipment, or they sell commercial real estate, or they're involved in transactions where there's a huge value add into being a partner, along with the fact that they're going to make, the commissions, which are, high paying, right? So it's all about working together. It's all about really doing what everybody can to ultimately get a deal through the finish line. There's more reasons that deals don't get done than there are that they get done. That's the one thing I always remind the sales teams and the guys on the sales floor, is because sometimes it's out of our control. It's the borrower, it's the lender, it's the guidelines, it's the government, it's whoever, right? If we're talking SBA, it's a little bit of all of them. But, realistically, don't be the reason that the deal doesn't fund, right? And if you can have a really solid, rock solid partnership, as I would call it, that streamlined process between us and yourself really allows the back end of everything else to work together. So if you're somebody who is looking for more information, you're not sure yet, or if you're like, Tony, stop talking, I just want to sign up, this is the link for you. Please pull out your cell phones. I know it's 2024. Everybody got them. Scan this link here and it will take you directly to becoming a partner now. You get access to directly into our CRM through our My Partner portal, where you'll be able to go through your pipeline, get access to training, marketing materials, custom landing pages, white label experience. How many benefits you think I could list?
I think we could fill several pages.
Yeah. But no, please, if you're new, let's rock out together. If you're not new or you are new and you're wondering, all right, how do I stay up to date on this stuff? Social media is probably the most important area. Every one of us have our own social media. This here is a chance for you to follow the Rock social media, where you'll get daily business tips, sales tips and tricks, how we market our products, what partnerships we're looking at, all different types of things, whether it's regulation related, whether it is product information related. We make sure that anything that's happening in commercial finance and fintech, you're aware of by following us on social. So make sure that you're following us, and we will follow back. Right, ladies? We're following back. All right, good. They gave me the head shake from behind the camera, so we're good. I think we're kind of getting there. If you're somebody that doesn't want to wait, right, feel free to call us now, 833-3-ROCK-BIZ. That's 833-3-ROCK-BIZ. I feel like I'm on the radio when I say that. But no, feel free to check out our website. You can email us. One thing I want you to know is we're real people. We're here to really talk with you, have real conversations, and we're excited to get a chance to connect with you. We will be doing another webinar in April. I don't remember the date. I know we picked one, but I don't remember the exact date. Anybody know why we got two screens up?
One for each of us.
Did somebody else join? They're getting kicked off. Yeah, they're getting kicked off, whoever they are. They're not really Rock Financial. Did we get hacked? Can't say that too loud. Lauren's freaking out behind the camera now. Oh man. All right. So Q&A time. If we did not answer your questions, please drop them into the Q&A. The number one question that we get asked probably 500 times throughout the presentation is this being recorded, and will you share the presentation? Absolutely and absolutely. As soon as we wrap this thing up here, we put a bow on it and we send it out to you, just so that you have it in case you want to refer back to it or you need any of the information. Going to dive into the Q&A. Always start at the top, and want to make sure that we get a chance to answer everybody's questions. So feel free to drop those questions into the Q&A. We got a bunch in here now. It looks like Christina answered a bunch. Love it. All right. I'm new with Rock. Do you handle requests for non-MCA loans like SBA, business line of credit, et cetera, et cetera? Absolutely. SBA is a major initiative for us in 2024. Feel free to send those requests this way. When you are thinking SBA, think Rock, because I'll let Steve go into this a little bit further, but a lot of people will tell you, hey, send me your SBA deals, and then try to sell them an MCA.
Very common.
We have the ability to not only get your SBA deals done, but we are also able to put a layer between there, right? There are some banks out there that have taken it upon themselves to put a layer between SBA and MCA. I'm familiar with a few of the different products. I'm going to lean more on Steve on this because it's a lot of those non-bank SBA providers that have spun off a term loan type of product. That's or, right. Yeah. Those types of things. So tell us a little bit about that.
All right. So yeah, first point. Yes, we hear it all the time. Borrowers looking for an SBA loan, they apply with a broker, or, obviously it's on the broker level. A broker comes back, no intention of preparing an SBA package, just comes right back with an MCA offer. Borrowers can't stand that. That's obviously not the way we're going about it. SBA financing is a vertical that falls under our commercial finance division. So that's one of the verticals that I cover in commercial finance. What Tony was saying, the point that Tony was saying in regards to lenders that have started to kind of not really be too excited about consolidating MCA debts. There's a fast track product that goes up to 150,000. I'm sorry, fast track is okay. Excuse me. Boost loan that goes up to $500,000, an SBA boost loan that goes up to $500,000 that does not allow for any consolidation of MCA debt. So going forward, SBA is probably going to continue to tighten some of those guidelines on consolidating MCA debt. As just noted, they already started it with Boost. So that's something to be aware of. The only time we're going to convert or potentially pivot to an MCA product when we have a borrower that's potentially looking for SBA financing is if they simply don't qualify and there's no other product available that's similar. As Tony noted, there are many non-banks that are starting to push similar products to SBA, but they're not SBA backed at all.
Correct.
They're just portfolio loans for those particular lenders.
Correct.
Slight variations in some of the guidelines.
And definitely the terms a bit, right? Like they're
Absolutely.
We're seeing some of these terms are as little as 2-3 years, some are 5 years, some are 10-year, some will fully amortize them. But for the most part, we're talking, that 10 years at the very maximum.
Yeah.
You'll see 5, 7, 3, 2, 48-month.
A lot of them max out at about $500,000.
Yep.
Some of them, although I have a couple of lenders, and again, this is new hot stuff that's happening right now in terms of like an SBA alternative.
Yep.
So a non-bank portfolio product that can compete with the SBA 7A product, which goes up to $5 million and is a unicorn in the sense that it allows for a very wide range of use of proceeds. So we're starting to see non-bank lenders on a portfolio basis looking to match that type of product capability.
Yeah, absolutely. And why is that important? Well, because now you don't have to meet SBA requirements and bank requirements.
That's right.
It's just about meeting the lender requirement.
That's for sure.
And once you've met that requirement, the deal's done, right? Rather than having to wait for SBA approval and SBA this and SBA that, it shortens things up a bit. It makes things a little bit cleaner. And because of that, the bank is able to save a little bit of effort, time, money, and pass that savings on to the borrower. And that's where this whole thing kind of comes up, right? So there is a layer of lending between there. That's for sure. And if you start to talk about assets, that's where, things can really open up for a borrower potentially. When you're talking about like equipment finance or commercial real estate, or even fix and flip or, residential investment, those things all help. Why, when you're borrowing for those reasons, that helps with the terms
For sure.
when you're tying those types of assets to a deal. So just keep that in mind. Keep going with the question here. What if a new business like a restaurant, can they apply for equipment financing? So this is a trick question. They can certainly apply for financing if they are a new startup small business. You heard me. Startup small business, if you are looking for equipment, can apply for equipment financing. What are the criteria? Well, criteria number one is you're not going to get more than $75,000. So keep that in mind, right? Your overall financing request can't be more than $75,000. You are going to have to put down capital to be able to access this. Typically it's 20%. That's just a good number to start. You might get 15, you might get 25. So don't hold me to it. Don't hold me to that, but it's a good place to start. And the last thing that I would tell you is you got to have great credit, not good. But
excellent
great, yeah, excellent. You have to be above average in terms of your credit. So yes, equipment financing they can apply for. In fact, I remember recently Ryan, who does a lot of our equipment deals, he works all over the world, but I don't know where Ryan is at the moment, but he was here in New York on Long Island. We were having our Christmas party and he was in the office and there was a local restaurant starting in Queens. And, he took a ride out there and was able to solidify the deal in person. And that was a startup restaurant, right? So, yes, you can get access to startup financing, $75,000 max. Need at least a 720 plus credit score. And you're going to look at 20 to 25+% down. What are the typical rates obtained on these loans? That's a trick question. Shout out to Ro for throwing us the curveball of all curveballs. No, I'm just kidding. If you're talking outside of the secured world, right? Outside of commercial finance, like Steve was talking, rates are going to be solely based on the business themselves. I can tell you that there is kind of a bell curve to rates in the working capital world, where you have a lot of people that want to lend you $100,000. Because a lot of people are lending $100,000, the rates and terms are very favorable at $100,000, right? You can get the longest terms, you can get the cheapest rates, you can get the best payments at 100 grand. Because there's so few people willing to give you $1 million cash, the rates go up a bit. You know, it's not the same starting rate as it would be if there was one less zero on the deal. You know, it's typically a few points higher than that. It's typically a little bit more risky. You know, so just keep that in mind. The idea is when you're borrowing that money, I'm borrowing X and I can expect Y. And as long as what my cost is being Z isn't too much, you know, it makes sense. And I always say dollars got to make sense. So on the cash side, it can be a little bit more aggressive than a request that, you know, maybe $100,000 or $250,000, simply because there's no competition there. There's probably only one or two lenders that are doing that deal to begin with. On the commercial side, that's like a core deal. So you probably have the biggest range of rates, the biggest you know, the biggest variety of terms there.
Yeah, I mean, I'll give you an example. So like if I'm doing a land loan and it's outside the state of New York or the tri-state area, you know, minimum for us is going to be $1 million. That's the loan amount. I mean, it's harder to place a sub $1 million loan on certain collateral than it is to place a $5 million loan. Simply because the way the lenders look at it on the secured side is that, you know, if they're going to put the time and effort into underwriting one of these transactions, which could take, in some cases, 2-3 months, you know, they want to make sure that the ROI is there.
Sure.
So that, you know, the return on investment meaning. So, you know, if they're writing a $100,000 loan and that $100,000 loan, it's the same type of collateral, land-based deal, 100,000 request and $1 million request. It's going to take them probably the same amount of time. They got to wait for the same process, right? We got to wait for an appraisal. We got to underwrite the financials. We got to look at the credit. We got to go through the title process, legal, all that fun stuff. And the ROI, obviously, on a $100,000 loan is going to be substantially less than what it would be on $1 million loan. So that's what lenders on the secured side are often looking at. You know, a lot of them are going to have a minimum dollar amount, and believe it or not, for most of them, $1 million is kind of like a starting point. Inventory-based loans, for many scenarios, majority of the lenders we work with, you know, they're going to start at $1 million, same type of scenario.
I see one here. Do all loans require all members of the LLC to personally guarantee the loan?
Yeah.
It's a good question. If you're talking SBA, anybody with more than 20%, that's an SBA requirement. But I would tell you that this is a lender by lender requirement. We have some lenders that require 51% of ownership to be on the transaction. We have some that require 67%. We have some that require 75%. Some that require 100%, depending on the exact transaction. So I would tell you this is a lender by lender thing, a transaction by transaction thing. But the answer is actually no. You don't need all members. Do you do straight construction loans?
Yes, absolutely. Certainly. So we can do ground up construction, land development, conversions, renovations, fix and flips, any property type in any stage. So what do I mean by that? So when I say property type, we can work, well, it can't be a property that a person is going to live in. It can't be like a primary residence. We don't work with those type. That's a residential financing request. Or a residential mortgage. We can, however, work with residential investment properties. So meaning non-owner occupied residential properties. So Could be a fix and flip. It could be a ground up construction and flip. It could be a ground up construction and hold. It could be a multifamily, so a 5+ unit, industrial properties, warehouses, retail centers, land development in the sense that, it could be residential, 100+ unit residential development. So 100+ single family homes, let's say, or condos, townhomes, mixed use. So it's got retail and maybe some residential involved. All of the above. We can work with all those types of properties. And again, so from land acquisition through entitlement, which means that that's the phase of getting zoning and getting permits set to build whatever, construct whatever property type or improvements they're looking to develop on that parcel. Through horizontal construction, which would mean infrastructure, grounds, access roads, things of that nature, and vertical construction, which is actually building up or building vertically, actually building the property, constructing the building itself.
So I know we're pretty much wrapped up on our hour time slot here. If you got to go, I want to say thank you so much for rocking out with us. I'm going to answer a few more questions here. I think we can kind of rapid fire some of these that are left in the chat. I just want to make it known that we're probably going to get wrapped up here. So if you have any one-off questions or anything that you want answered, throw those in the chat now. And again, if you have to jump off, I totally understand. Do you deal with non-bank lenders? Yes, absolutely. Explain FICO credit score versus the company credit or business credit, and do you require both? So the difference there is substantial, right? A personal credit score is something that you're going to see, their personal vehicles, personal properties. Commercial credit is totally different. It's weighed different. It's going to be based around the business and the types of trade lines that business has. As far as us, yes, we require both, and no, we don't require both. I think that's a fair statement, right? Some of our lenders, like for example, some of our working capital lenders do not require even to check your personal credit, right? Some lenders are based more on personal credit than on the business credit side of things. So it's totally a lender by lender thing. We take a look at both because we're going to put together the strongest application possible, right? So if somebody doesn't have the greatest credit score, well, then one of those lenders that I was just talking about that doesn't require a minimum credit score is a great option for them. Are you a direct lender on any products? No, we are not a direct lender. We strictly stick in the broker seat. We like to stick and move. No, we are very good at what we do, and we believe that, our strength is knowing our lenders and the lender relations. So we utilize that to the fullest for sure. Just really quick, I see a few duplicates here. Can a client be referred as a lead only without documents, credit, or any background? Absolutely. We will call the lead. We will qualify the lead. We will bring in the documents and fund the deal, and you will get paid. That's the name of the game. You can be involved as much or as little as you'd like, right? So if you are somebody that has the docs, I don't want to shy away from that. But if you're somebody that you're able to drive leads, please do so. Put us to the test. Where can we get leads? My knee-jerk reaction, referral partners. Maybe because I'm the referral guy, right? Leads are a funny game. This is a tough question to answer in 2024. I've been begging Megan, who's our CMO, to get on one of these webinars with me and fill you guys in on that answer. But I would tell you the best place to get leads is the one that works for you. Right. Some people have a skill set that allow them to acquire leads through digital means, through digital marketing. Some people have a skill set of people, right? If you are that type of person, good, get out there, shake hands, kiss babies. You'll meet some people that are looking for money. When you sell money, it finds you. That's one thing I've learned. they will find you. So just get out there, spread the word if you're that type of person. I can tell you that there's 33.5 million small businesses in the US, and financing is not an if, it's a when. When you think of financing, think of rock. No, I appreciate you guys rocking out with us. It looks like we have a few duplicate questions here. One asked the question, do we do business in Maine? We do business in all 50 states. So yes, we lend in all 50 states. There's no minimum FICO credit score, no industry restrictions. We will do deals in the cannabis industry. We will do deals in, every industry that you can imagine, every type of borrower that you can imagine. If they have a small business and that small business has a need, let us help them with information and ultimately guiding them through the process.
One note on that, we actually, just a lot of people may not realize this, but we can on certain types of projects, especially when we're talking about real estate or retail or wholesale distribution, even manufacturing or fabrication, we can look at international transactions as well. For example, we have a $76 million construction project that's in underwriting currently for a project in the Bahamas. In Punta Cana, and we're looking at a $38 million construction project in the Bahamas right now as well. So, international, as long as the deal makes sense, we can certainly look at international deals as well.
$5 million minimum. No.
That's actually, that's probably a good starting point.
I got your back, Jack. I knew that was going to be a question. All of a sudden we got a, $30,000 restaurant request.
No, it may not make sense.
No, the one thing I want you guys to keep in mind is we're going to be back here again next month, giving you more information, giving you more insight. I want to thank Steve for joining me again. I want to thank you guys for rocking out with us for over an hour. And thank you for your questions. Thank you to everybody that put this thing together. And make sure you're keeping an eye out for the announcement about our next webinar, and we'll check you guys back here next month. Thanks, everybody.
Thank you, Tony, for being an iron host here as well.